This is Justin Pulitzer. This is my weekend review for Sunday, February 28th, 2016. A good amount of material to cover. First, I want to start with, if you're watching this video, a lot of people watch it as soon as I post it. It sometimes takes a little time for the higher resolution versions to render. So often people are like, oh, the quality of the video is not that good. This video is being shot in 5K. YouTube does not support 5K. They go up to 4K. So I assure you, if you put this on and it's not that crisp, if you wait a little while, this thing will be amazingly crisp, major HD, super clear. So if you're experiencing that problem, just hang out, let it upload or however long it takes, and watch. I have no control over that. I upload it to YouTube, and then they take their sweet time getting it in the higher resolutions. Anyway, with that said, let's jump right in. We had a pretty decent week, a nice rebound in the markets. I can't say that was unexpected. We had discussed that I thought there was a little bit more in the tank. So let's just start off with the 6 market keys, go into the Fed keys, and then just hit the indices and a few of the momentum stocks that we follow. So a few weeks ago, I mean, I assume everyone watches every week, but you never know. I have a VIX key I created for you guys. People were asking me, how do you use the VIX? So I usually don't play the VIX directionally unless it's like really crazy. Like if it's really low, I'll sometimes play it by buying some calls for a move higher. But let's talk about it. So VIX 0 to 15, IV is low. You're playing purely directional. That's like calls, long puts, long spreads. 16 to 17 is basically fair. Also, same kind of directional play. When you start getting above 17 into the 18s and 19s, that's kind of getting medium in terms of volatility, and you want to start thinking about selling premium. When VIX is 20 to 22, it's elevated, and you want to definitely be selling some premium there. The nuance comes is if you start getting above into 23 to 25, it starts getting to be the high end of range. So this is really when you have a lot of panic in the market, a healthy, quote-unquote, healthy amount of panic. If you start getting above 25, though, and you can see this is the 25, that's really where the problems start beginning, and you kind of get these spike lower. Anything between 25 to 31, which is this band, you have crash risk. You could see what happened here. This Friday here, you closed above the 25.20, and then you had the flash crash the next day. And if you're anywhere above 31, you're probably in the middle of the crash is already happening. It's sort of a little late to buy the insurance when when the roof is being ripped off the house, so to speak. Anyway, I've been talking about some dangers in volatility, that we are making higher lows and starting to transition to higher highs. However, on this spike here, we had a low, a lower high, and now taking out that swing low. I had talked about us maybe seeing the 200 MA, which is basically where we got, and then the 1785-ish to 1757-ish level being some support. So there is a little bit more room down here, potentially even to the trend line, but it's definitely, IV is definitely not as much of a an ability to sell it here as we had up here. So my fear that I've been talking about is that I shouldn't say fear, but I should say my prognostication, reading the forecast here, is that we went from a period of very low implied volatility, you can see lower highs, lower lows, or equal lows, to a period now here where we're starting to make higher highs off higher lows and potentially transitioning into a period of higher volatility. So you really have to keep that in mind here. The 200 MA in this area here, like I said, could be some support. Maybe we see the channel low. That's the VIX. So I've been talking about the dollar. I often talk about the ETFs. I like the ETFs for retail. So I drew in a range. We kind of had this like spike high, came down, and then we've been kind of ping-ponging in a range. Moves below have been unsustainable. Moves higher have been a little bit more stubbornly sustainable, but in the end, not sustainable. Lower highs, lower lows. We got back to a kind of a downward regression line here. We closed below the 50, although, like I've said for a while, my biggest fear for the U.S. economy And, listen, I can play the market long or short, but in the end, I'm a patriotic American and I like to see the country do well. In the end, this is a big problem. Corporations price their, basically that do business overseas need to translate those into dollars, and they need to compete abroad. This is the big problem that Caterpillar and these companies have been having, is that the Asian countries like Japan, for instance, devalues their currency so much, and companies like Komatsu eat their lunch. This is a major problem for U.S. corporations. It's good that we're making lower highs with lower lows, but you have to be really careful that this isn't just some kind of consolidation that gets a run to retest the highs. So we're going to have to see how that goes. I think if the Fed starts hiking rates more aggressively, this dollar will explode. The Fed has mentioned in the past that they're aware of this and their big concern is the dollar. If you factor in the fact that there's not a chance of really a rate hike being factored in until at least 2017, or even in some instances I've seen 2018, the dollar probably could be in for a little bit more pressure. But that is yet to be determined, and it is still very, very strong. The bonds. So bonds, we've been in a pretty strong bull market for a while. It's been in a fairly defined channel. We've just been kind of chopping around. We're rolling over a bit in the stochastics, and you can see we have a bit of a lower high in place. I want to talk to you about what this means. I've had a lot of requests lately. I had mentioned in the last video about doing a special on bonds. I'm going to need to plan that out a little bit and find some time to do that. I do actually have a fairly busy schedule, and to create this is a little bit more sophisticated, but I am happy to do it. If you're also, it's something I'm considering. I had a few people request it. I'd like to just hear a few more if you're really interested or not, because like I said, that's a little bit more of an in-depth type of thing. I was actually thinking about doing some kind of webinar and maybe doing that'd be pretty crazy, right? A bond webinar. The stock guy who trades momentum stocks is doing a bond webinar. Believe it or not, I know a ton about bonds. I probably know more about the bonds than some of these guys that trade in the pits and do this professionally. I studied this for years in college, and I actually have a lot of experience with valuation in bonds. So I probably could do a pretty comprehensive video on that. If you're interested, please leave a comment or send me a tweet or a DM. I have my DMs. Whether I follow you or not, it's open, so people can always follow me. Always can DM me. I'm just kind of that kind of guy. Anyway, so we had a run-up in the bonds, and I think the media, for some reason, they don't really understand how stocks are valued. There's something called a discounted cash flow model, DCF. If you want to do a little preliminary work on this, you can Google that. And there's basically that's basically a forward discounting mechanism to come out with a stock price. Basically, you put in a bunch of inputs, and if I could also do a DCF video also. That probably would be. It's a little wonky, although I assure you it's actually quite illuminating. You don't really need it these days. I did a lot of this in business school when I was studying finance, but if you go to a Bloomberg terminal, you can pull it up. If you go online, there are mechanisms to do it. Although there is definitely something said about being able to do that on your own and kind of understand the internal components. Because that's way when stock prices go up and down or factors really change in the market, you understand why prices are moving the way they are. Anyway, I assure you, lower bond yields, which means higher bond prices, is great for stock market PE multiples, and that is partially why, my friends, the bears have been sorely disappointed and haven't gotten the breakdown they want. I know at times it seems that the bond market is rallying when stocks are going down, and that is for a few reasons. One is recession fear. When the bond market rallies like this, you get spike ups like this, when it starts going parabolic, people are starting to think recession. A lot of this, what I think is happening here, is that there is a lot of trouble around the world, and this is also partially why the dollar has been so strong. Foreigners, The Europeans, we all know that UBS and all these Deutsche Bank, it gets talked about a lot. I'm going to just flash to those charts rather quickly just to show you what I'm talking about in case you're not in the know. Take a look at this thing. This thing has been basically I don't want to say a dumpster fire, but I did, so it is. It's really weak. This is not healthy. You don't want to see, if you have your money in an institution like this, you don't want to see a stock chart like this. And to just show you, I'm not going to go through them all. I'm just going to use this one. I'm sorry. This is just going to kind of be my whipping post for the day. Take a look at where the 2009 crash low was. This was the end of the world, and we are below there. That, to me, tells me there is something rotten in the state of Denmark. See, you get a little bit of Shakespeare with my videos as well. So it's not only finance, you get a little bit of an English literary lesson as well. Anyway, we are below there. That, to me, says that there's something going wrong. And that tells me that foreigners are taking their money out of their currencies, selling euros, selling yen, selling whatever's not nailed down, buying US dollars, and then buying US treasuries. Why would you buy treasuries? Yields are so low. They're 1.8%, 1.5% up in this area. Why the hell would people do that? The answer is that the Europeans never got on board with FDIC bank insurance. And people need, when things get iffy, squishy in the markets, they start worrying about a return of their capital and not a return on their capital, meaning they're not worried about profits, they just want to get their money back. And when you have millions of dollars and you don't want to wake up and have a situation like Greece where the ATMs are shut off. So what do? You buy bonds. Exceptionally, extraordinarily wealthy people buy bonds. And they use that as a store of their money. It's basically like a safe deposit box that if you buy tips, maybe keeps up with some inflation, but these aren't the inflation-adjusted ones. But basically, it's a deep liquid market. You don't move the price on yourself when you buy or sell, and you can move huge, huge swaths of cash. Anyway, that is good. So let's get back to our DCF analysis. You have a numerator, a denominator, and an end product. This risk-free rate, as it's known, is a huge component of the denominator, which comprises of what's known as the weighted average cost of capital. It's basically a fancy formula that takes into consideration how much equity and how much debt are in a company. It's an amalgamation. If you want to Google that, you could go through it. Just put in WAAC, weighted average cost of capital. It's also on the street known as WACC, or business schools everywhere known as WACC. And the lower the denominator is, the higher the end product is. The higher the denominator is, the lower the end product is. So this is very important to PE multiples, and this has been stubbornly strong, which is very good for higher PE multiples. And I think that's also been a cushion. It's the only game in town, and it's kept the market from kind of really seriously more imploding. The other really huge thing that has been driving the market is oil. I don't want to go back, but you saw the Deutsche Bank. This was the reference low from the 2009 crash low, the 33.20. The world is a very different place from back then. Yes, the world economies have been suffering. We are teetering with stall speed growth basically everywhere, with recessions, high unemployment rates throughout the European zone. And we have a situation here where the U.S. companies have been technologically superior. We have a lot of natural resources in the United States. Think about all the shales. People basically got smart. They discovered better ways to do horizontal drilling and hydraulic fracturing, hydraulic fracturing, and they have been able to get at oil and gas in ways that could not happen back in really effectively in 2008 and 9. So I've been saying for a while that I think oil is kind of trying to bottom. Yeah, it's sure. If we start getting below 25, 26, which I had said was an important level. This was a long-term resistance level for most of, I believe, the 80s. And when we broke out of there, we are now basically retesting. So keep a look at what is happening here. We've kind of broken a little bit of a downtrend within a down channel. We're starting to make, we had a excess, a little bit of an excess low here, higher low, and now chopping. This is starting to look, believe it or not, inverse head and shoulder-ish. And we now have a 50 MA that is starting to turn. So if you want to play right or right out, you can use the 50 MA or use this candle body here, which is roughly 32.20s, I want to say, 32.18-ish. Could use that as a stop. If you've got a little bit more brass, you can use 30.56 as a stop below there, which is the 20 MA and this swing low. I actually like that area a lot. The way I've been playing this, frankly, has been with Exxon Mobil. I've been playing the range. Yeah. So when we get down here, I sell the puts. When we get up here, I take them off. I haven't really been going short because eventually I think Exxon will get back up to 100, and I don't really want to be caught on the wrong side of that. The good news here is that we are in a bit of an up channel. 200 MA held here. I actually put on some put ratios and sold some extra puts, so I'm long Exxon, but I'm protected. I will benefit if it goes lower, if it just doesn't completely fall out of bed. That would not go over very well in JP land here. 50 MA is right around the 78s. This was roughly some support. We've traded some, it's kind of like a volume distribution, the 77, 78s. If you start getting below there, you'll obviously see the 75, 76, and maybe the 72s again, maybe 71s. I think it's gonna kind of chug. This is, I'll tell you what. One thing that people don't realize about Exxon is that it's a really big liquid name that institutions like Warren Buffett had been in this before. I think this is sort of the safest of them all. It's the one that will be they have an impenetrable balance sheet, and they will be positioned very well to buy these kind of pissant companies that got into the oil business when oil was much higher. They'll be able to buy up their assets on the cheap. They will likely be the last of the Mohegans, so to speak, to cut their dividend. I'm an Exxon fan. I've liked Exxon for quite a while. It is often one of the best performing stocks in the S&P. It's been under some pressure the last few years, but I don't know. I guess they say long term, no one really ever lost money in Exxon. I mean, it's sort of, I'm a fan of the Exxon, so to speak. So China, you gotta have your China, right? China is an important component to the world. It's been driving global growth for quite some time. It's been under some pressure lately, and a lot of that has been taking away the excess of this move. All right, so where are we? We're basically back to these lows. They undercut them short a little bit. Once we snapped, we filled up the triangle, although it took a little time. Here we looked below, came back up to the breakdown point, and then kind of gave up the ghost. So this area is an important level to hold. That is key. If we lose there, it's sort of round and round she goes. Where she stops, no one knows. I mean, this could conceivably see 19 again. I don't necessarily know that it's going to happen, but I can't say that it won't. You have one leg, two legs. Maybe we're setting up for a third and a final leg washout. I guess you could make the argument that this was leg one, this was leg two, and this was leg three. To my eye and my experience, this is probably really just leg one. So, and this is leg two. But hey, that's open to interpretation. There's a lot of ways you can see it. Anyway, regardless, this is the level 28.61. If you're long, you want to be long against that. If you start breaking there and you start breaking the 28.10, you want to be not long and probably want to be short. Simple, to the point. Some of the stocks that people traffic in, they like to talk tough about in some instances, are the BABA and the BIDU. Look at this. I would say that this could even potentially constitute a higher low, rallied up. The problem is with this is that you have a lot of, this pattern here was a bullish consolidation pattern that failed and broke down, and it did so at a point where there was a lot of past supply. You can see up here, broke down. All these people were like, oh, please, no, get me whole. I'll never do it again. They got whole, and there were no more buyers. So you have now a higher low potentially. You're rallied up, failed at some past consolidation, chopping. If you're long, you want to be long here. The 20 is starting to turn. I could say you could be long against the 20. If you lose the 20, you don't want to be long. You probably actually want to be short again. Not sure how well these lows would hold if we came down there one more time. If you're long, you probably want to look to target the 50 and then maybe eventually get up to 78. For a while, I've said I've thought this stock will get to 100 again. I still think it might. I just don't know the order in which it gets there. But that is my opinion about it. BIDU. This was a shame that it really rallied a lot ahead of earnings. It did get a bit of a sell-off, but it didn't really get as much as maybe people were hoping for. I was really hoping we got a retest here of the trend line and these lows. That would have been an amazing setup. Anyway, we do have a what could constitute a professional gap. You're above a swing high, and you're basically above the downtrend. The problem is that there is some room here to a gap fill, maybe 185, but you have some moving average resistance here, the 200 and the 100. So I'm going to keep it real simple for you guys. Anything above 176.81, which was the gap day high of day, you can try long with a stop below that low, 172.20. If you get below 172.20, you could try a short with a stop over 176.81. Very, very simple. That's how I like my stocks, nice and simple. All right, so one of the other proxies of risk on and risk off has been this IBB, which is the Biotech index. All right, so we had a head and shoulders top, a breakdown, retested the breakdown, basically double bottom, rally, it formed an inverse head and shoulders, which was looking like it was going to fail. We retested the high of range 3 times, was not a charm, and it not only took out these lows, it made some fresh lows, and we're kind of hovering around these lows. Why is IBB this weak? All right, for a few reasons. First and foremost is the headlines. This is the quote-unquote why. Everyone wants to know why, right? Hillary Clinton, Bernie Sanders, Donald Trump all want to negotiate prescription drug prices. That is not good for the companies selling drug prices because that's going to hurt their margins and profits. A lot of these stocks traded very low PE multiples. That is what always happens at peak earnings. When PE multiples get really high in these, that's usually the bottom, but that isn't the case here. Very low PE multiples could mean peak earnings. So if you're getting, I don't know, let's say, I'm just going to use 100 because it's a nice easy number. You're getting $100 a pill. Now you're getting $20 a pill. That's a big problem. So that, at least, it's great for the consumer, the person buying the pill. They'll have a ton more to disposable income to spend on things like iPhones and big screen TVs and, I don't know, whatever. But they won't be going into the coffers of big drug companies. So we're close to 100% retracement. It's also a 1.618 fib extension from this range, which would be 212 to 207. I would be interested in selling puts around that area, although it wouldn't surprise me to see some type of an undercut. But considering the fact that it would have basically been cut in half, I would be a little bit more interested. So technically, what the story is. I just showed you the technical breakdown, the issues there, and this is something that probably isn't talked about as much by chart technicians because a lot of them are just looking at this chart and they don't understand the internal mechanics of the stock market. A lot of the big stocks like the Gileads, the Celgenes, the Regenerons, all these types of stocks make up this IBB index. And when managers don't want to necessarily have individual stock risk, they buy the IBB. The problem is that the IBB consists of these stocks. So if you sell the IBB and there's a rebalance at the end of the day or what have you, then the stocks have to get sold, and then when the stocks get sold, the IBB has to get sold, and then the IBB gets sold, you have to sell the stocks. So it becomes a very vicious cycle, a self-fulfilling cycle, a closed loop of death. Yeah, so that's part of the problem with the IBB. A lot of people are involved in the ETF, and it's the pressure of them selling is forcing the stocks down, which is in turn forcing the ETF down. So that's IBB in a nutshell. Let's talk quickly about the Fed. Yeah, the Atlanta Fed they've been all over the place with raising and lowering their estimates for GDP. The problem is that we're basically, at best here, a 2% economy. It doesn't take a whole lot to knock over a 2% economy. If the wind blows a little bit too strongly and we have a cold winter, we are basically at zero or slightly negative growth. Very, very precarious place to be in, particularly with a Fed who is potentially switching policies to tightening. Not good. Not good. ISMs have been weak. The manufacturing was weak, and they said, we're not really a manufacturing country anymore. But then the service ones were negative too, recessionary, and then they couldn't make excuses anymore. Same thing with the PMI. That's basically the same story. Oh, yes, the durable goods. We know that Boeing is producing half as many 747 cargo planes. We know autos haven't been able to get out of their own way. Good numbers or not, we could be seeing peak autos. Housing has been doing pretty decently, but if interest rates do start going higher, that will not be good. And yeah, there was a durable goods number that came out recently, and everyone was all excited. I guess after 10 months of not buying anything, people finally sprang for toasters. Woo! Yippee! So I wouldn't get too excited over that durable goods order read this week. It is still the real guts of it. I don't think we're not going to be a toaster-powered economy here. We need to be a Boeing-powered economy, and Boeing is got a litany of issues. We know they had some accounting issues. We know that they had the sales issues. The best thing Boeing has going for it here, and I will show you this, is we are been in a long-term uptrend. We had a bit of a look below. We stopped at a 61.8 and rallied. And we have a 200-week MA here that we're holding, and we're basically down, basically still above these flash crash lows. If you start taking out, however, oh God, did we freeze up here? I hate when these charts freeze. I'm sorry, I have multiple time frame Fibonacci's on here, but I'm going to give you some levels, and if this would ever unfreeze, there we go. So the flash crash low here. The problem I really have with this technically is that you have you had a flash crash with lower lows and lower highs, a rally up here to a significantly lower high, basically equal highs here, and then we took out the flash crash low. So anything in my view below 115.14 is not good. It's really very vulnerable. But if you're below the body of that day, and you can see this rally back here, the body itself couldn't get back over that body. A lot of people don't know about the bodies, but I do. 123 half-ish. Anything below there to me is still a little bit vulnerable. The close here was 118.16, and we're basically into this range here. If you were to lose this week's low here, this 112.51, I will not be thinking good thoughts, not happy thoughts about Boeing. It to me would be too much. You'd be below this failed attempt of the 200. Here you kind of got the 200. Anything below this low to me is frankly, I think toast. But for the time being, we're holding the channel low. We could have a throwback to the mid of the range. I did draw in a regression line here. There's a few ways to draw them. I assure you that this is the correct one. And we really should, quote unquote, if the stock is healthy, get back to that regression line. It would be good if it took a little time and then it kind of coincided with these lows to set up a reference right or right out short. I just hate where we rallied here like this. Look at let me see if I can. I like drawing boxes. I'm all about the boxes. I like boxy cars too. Anyway, so I got jokes tonight, right? Anyway, we are kind of looking into this area. You do not want to be below the box. Below the box is very bad. In the box is sort of, you're okay, but we are kind of just. I would even, if you want to get really cute and you want to not think about wicks and you want to just think about the bodies, so to speak, you can even, let's use there. You could even draw it there and say that like these were kind of look below the ranges that failed. So we are now comfortably below there. You want to be careful with this kind of stuff, believe me. This is a game of inches. You want to be super-duper careful. I already talked about the dollar, and the last kind of non-talked about Fed issue that we all know they look at is the stock market, the S&P 500, which is now rolling over stochastically. It's got plenty of room to the downside. However, this is a little bit nuanced here. We have equal lows here. This is now like basically a quadruple bottom. So if we were to lose these lows, you not only don't want to be long, but you probably want to bet the farm short. Considering it would be from a significantly lower high, a still lower high, and then taking out that area, we would likely see trend and these lows and potentially even still lower. I've been saying for a while, I don't know how long it'll take or when we'll get there. We may even go higher before lower, but at some point, I do believe we will see, I'm starting to sound like Martin Luther King here. Someday, I do believe we will see the 2007 top at the 157.52, and that will not be a pretty day for people who bought the top. Let's get a little bit more real, so to speak, in terms of not being so, existential. We basically have a big topping out process. We had the flash crash, which was the signal to kind of get out. We had the rally into the end of the year, although it didn't do it in the time frame that the TV schmucks wanted you to do it. Sorry. We basically fell back out of bed, and now we're trying to form a similar W pattern that we did here. I will say this. There are some good things. There is some good here. And there is some things to be wary of here. So this will be a little bit of something for everyone. All right, so we still have some time if we want stochastically, if we want to rally short term. We are over the Fed day range high. This was this day. I gave the Fed day range low, the 187.06, the 191.56. We're above that. That is good. We have a 50 MA that we are now above. That is good. We have a 50 MA that is starting to level off. Great. Well, I wouldn't say great, but it's good. If this starts bending back up, you'll start hearing a lot about it. You have a 20 MA that has turned and is bending up. That is good. That is actually great. And it also coincides with the this sort of re-look into the this like sort of precarious trend channel low. So that is really where the rubber meets the road, and it'll soon coincide with the Fed day high, which I love. All about the Fed day ranges. So what's the problem? Well, I told you that I'm a fan of drawing boxes. And we have a very big box here, which was the topping out process, and the low of that is 197.86. That is fast approaching. We also have a consolidation range, a 61.8 from this high to this low. If we were to rally back, this would be the 61.8% Fibonacci retracement of the range, which coincides with the downtrend and also coincides with breakdown lows. Think about what I talked about with these lows, how I said there would be basically a free fall. Look what happened here when we took those out. They tried a little below. They tried to hold it, but eventually the selling pressure was too much. If we were to take these lows out, I think that we would have something in the market that looked like this and potentially like this on steroids. Anyway, you have a 100 MA up here. You have a 61.8. You have a past kind of resistance support area. This was resistance. It then became support and broke. It should be resistance again. It's also a little bit into the range. You have some key strikes. It's close. Look at this, 199.86. Sorry, 199.96 is close to 200. That's a big strike. I haven't looked in the options, but I'm guessing that there's a lot of option activity. There'll be a lot of people who just want to sell 200. I think up in this area will probably, and then even if you were to break there, look what you're dealing with. The 202s and then the 204s was a big support level that would be a gap fill and a resistance. So granted, that would be a huge move from here, but there is a lot of upward resistance, and I think that this area would be a great right or right out short. For me, I will be trying it short. So if we get there. I will not be trying it short if we go sideways for a while, get up there, and then chop, and then, kind of go. I will do it if we get there in sort of a straight fashion. Like if we were up the next couple of days and got there, then I would definitely be interested in trying it. Context is important. A lot of people don't realize that, but it's not always just about the levels. It's sometimes how you get there. That is key. So that to me would be important. If you go look at the SPY move for this week, it's supposed to be about $4 and roughly 3 cents, rounding up a smidge. It's like 1.028, so we'll just say 1.03. That would be 199.12, which is kind of close enough for government work to here. I bet it would test up a little bit higher. And then 191.06 is the low. So where is that? Sucker, 191.06. So basically around here, around the trend. Not surprising. So that is what's expected. So that's my view, that there is potentially a little bit more room up. This is all, like I said, a game of inches. We basically stalled here at the 50-day moving average. I think a lot of this weakness on Friday was just profit taking from these couple of days up. And also, of course, pinning, option pinning. This was roughly around 195. There was a lot of OI this week. Oddly, not at 195 initially. It was really at 195.5 and 194.50, 194.5. So it makes sense that we kind of just pinned right in between there. It kind of fudged a lot of people. So we got a 50% retracement. This really could be it if we open up weak on Monday and we lose the 50. I do think the 50 is a right or right out long. If we opened up weak on that on Monday, like if we gap down there, I would be a buyer there for right or right out. I will say that. And we really should retest the 50, considering we kind of just knifed through it. It would make a lot of sense to me to come back, considering these days were very rich closes, which I did discuss on the stream. But that being said, there could be a little bit more room up. The other indices, though, have me a little bit more concerned. The IWM, look at this. We broke trend. We try to rally to the backside of the channel. We made a new low. This, I will say this, though, and I did say this in the last week video, that this was a look below and fail day with kind of a secure low, and we rallied back up, but look where we are again. We're right to that kind of breakdown level. You have the back of the channel and the old uptrend and the 50-day. So this could be some more resistance. Like this is the kind of defining a range. This might be the upper part of the range, and this might be the lower part. So it wouldn't surprise me to see this back off again to at least the mid-range. If we can punch through there, then I think there is some room up to like the 106s and maybe even the 109, 110. That would be something else, all right. The Qs. Have been the strongest of all of them. You can see, look at this, we are still in the box. We've spent very little time below. The flash crash looked below. We had a couple of little look belows here. A look below. Finally, we had a few days below there, but now we're back into there. That's probably because FANG has some of the FANG has found a little bit of religion. But as long as you're in this box, I am modestly optimistic about those tech stocks. However, this like I said, this is basically a double top, and the weak often bring down the strong. And if you have the IWM fall apart and you have the SPY fall apart, this probably will eventually give, and probably give in quite dramatic fashion. We are close to a 50 MA as well, and I'm sure that there will be some right or right out shorts at the sort of top of this range. The Qs. What makes up the Qs? Apple, for one. Big topping out process, and it has been rather weak. We have been consolidating in a range. We looked like we were trying to be a little strong. It came right back on it. Higher low, though. I do think the 50 MA gets touched and we do get a gap fill here. So I do think we'll potentially see 100. We might even see like 172, potentially even 103. Problem is that Apple is acting really weak, and these quarters here, this one and another one, the iPhone 7 doesn't come out until after there, and Apple really moves on catalysts, and we're going to have a whole dreary summer of really not that much going on. I would be interested in Apple if we got down to this 61.8, 85.72, and even potentially if the market really softens, we get 100% retracement, basically down to 75. Can I show that to you? That would be helpful. Yeah, you could see, look where this rally really got going from. So it wouldn't surprise me to see a complete 100% retracement, particularly if this quarter is kind of junky. I don't know that that's going to be the case, but I would be an interested buyer there. The good news is that you don't need to worry that much about that type of a collapse because we have 92. Anything below 92, you probably won't still be long Apple, so you won't have to suffer through the indignities of that move down, which would be quite painful. We are kind of consolidating. We have a 50. I think that probably does get touched. If not, it shows that the stock is significantly weak. And if you lose 92, you could, I think, be rather short for a move down to that trend line. It should happen, I would think, pretty quickly at that point. Facebook. All right, so in all honesty, I don't know if I should have, but I did sell puts down here. I just got busy. I don't think I even realized I got the fills, but they worked out really well, and I'm probably going to start looking to take them off soon as we get close to the 110. I actually sold them when we were a little bit below the 99s, which was basically here where we kind of filled the gap. It wasn't a complete fill, but it was into the earnings gap day range, and it was the 99, and the game was on for me. So I'm going to start looking to peel those off, particularly even more so if we get up to that progression line that I've talked about. Longer term, I am very, very bullish on Facebook. Shorter term, I'm a little iffy because we got the 1.618 Fibonacci extension. So they came out with some stunningly great numbers. The Instagram ad numbers are good. They're monetizing that well. Everything is firing on all cylinders. The only thing you have to worry about this is if companies start pulling back their advertising spending significantly, they will be hurt by that. I do think that there is a bit of a structural change, like I've often talked about with Zillow. The real estate industry is completely changing, and I think that the dollars are going there. I think that stock just got a little bit ahead of itself in terms of pricing, but I am a fan of that, as on pullbacks. But anyway, that's neither here nor there. Facebook, we're talking about Facebook. A lot of the future, the dollars and the way people are not only getting their news and their information and buying products, is increasingly so online. And we've seen that with like the disastrous earnings reports from these Nordstrom, types of people. We're in a bit of an Uber economy. It's sort of, you have an iPhone. I do a lot of shopping on my iPhone. I bought stuff, believe it or not, on Facebook, and I think they're going to get even bigger with that. Amazon, that app is so dangerous. I can't even tell you. I have credit card bills that are much higher than they should be just because I can buy stuff easily at Amazon. Let's talk about Amazon. Let's do some Facebook levels. So up here, we're going to start looking to peel out some profits. And as we get back into like closer to 99, if you want to do also a 50 MA, that's also a good write or write out play. 50 has been an important area. It's also this range low. So that's my view on the Facebook. With regard to Amazon, we're not really seasonally good for Amazon, and this is starting to look like it's kind of going to have a big retracement. That would be great. I can't even tell you how much I would love a primary trend touch with Amazon. I don't know where it would be. Maybe it happens on earnings here. Who knows? That, to me, would be phenomenal. It would be a great buying opportunity because we know that these guys are kicking ass and taking names, frankly. However, we are in a little bit of a downtrend. We have a downward sloping 50, lower highs with lower lows, not a great pattern. We have this trend line here. We have a 200 MA. If you're long, I think you could use the this swing low as a stop now, which was 533.15. And if you're long, you probably want to use the trend line and maybe the 50 MA, since we didn't even get it here, which was a little bit telling. Probably close to the 50 MA is an area you might want to look to lighten up into. So Amazon is not looking as not so great. Apple not looking so great. Facebook is looking pretty good, though. Netflix, I called this as double tops. That was really, I got called a lot of nasty things by people online. It was right, though. We're making lower highs, lower lows. We've taken out swing lows. This was a dump low from October. It never saw it after hours. You could see, where was it? It was on 1014. Yeah, well, I should have just looked here. But this was the dump low. We never saw that low. Anything above these lows here, basically, you can see the 93s, you can, I guess, be long. Anything below there, you don't want to really be long. It's good that we're having higher lows, little bit of higher highs. Basically, though, range highs and 20 MA is starting to turn up. I think you could use the 20 MA as a stop if you want to be long. There is some room to the downtrend. It wouldn't surprise me to see a move close back to 100 or so, however long it takes. But I have said for a while, I do think we're going to retest 70, potentially even lower the primary trend. I don't know what the road to perdition is there, but I do think it eventually happens. So I would be looking to kind of short back up to where this kind of breakdown really took place, somewhere around the 103.88, and I've said 103.88 to 105. If we could ever get there, that would be a great area for right or right out short. And if it coincided with the downtrend line, that would be even better. Netflix looking a little vulnerable. Think about this with the Qs. Google. Long-term up channel. We're just chopping. I really don't, other than we're below this sort of uptrend, don't have much of an edge on this day to day. I just think it's going to be choppy. I am waiting with bated breath for it to get a channel low test to buy, or a move back up to the channel high to short. Pretty much sitting on hands until I get a little bit of a sign. The price line, it had it got down quite low. It rallied back up. It's really a shame that it rallied like this, and then it had this gap. I will say this, though, with Priceline, it tends to have these gaps, a little bit of continuation, and then they tend to fill. So I don't necessarily know if you, and you have a gap fill here, and a 61.8, and the backside of an old up channel, and it kind of is already starting to roll over a bit. So, not to get too TLC on you, but I don't know if you want to, don't go chasing waterfalls here. Also, so here we go. Past reference high, the backside of an old up channel, a 61.8, and having moved 330 points or whatever this is to my eye off of the lows. Yeah, there could be a fill. I like playing for that with put ratios, considering that once it filled, there was a bounce. So I like playing for a move, and you want to do that on down moves. I like playing for a put ratio. Simple price line. One I'm starting to get bullish on, and I've talked about, is this WYNN. Holy shnikes. This thing has been down really big. It got close to the real big breakout around the 43s. I could show you that if you want. Let's see, 10 years. Let's just go 10 years. 10 years weekly. Yeah, you can see after the 2009 crash low, this was like the reference areas, and then that's where it took off from. So we basically retraced most of that. It is now had a consolidation and trying for a little higher. The bad news is you have a 50-week MA coming up around the 86s, is it? Yeah, 86.79. So, and this has moved a hell of a lot off the lows, basically from $50. And look where we are, where a real breakdown took place. So I'm thinking you want to lighten up a little into there. But, and that's a big but, I like big, yeah. Anyway, I like this area here for a pullback. If we were to get back anywhere near the 50 and 100-day moving average confluence, I would be interested in being a buyer. So like somewhere middle into this range, into like the middle 60s, maybe like 65, 62. If we were to get a big enough pullback like that, I would be interested. A couple of warning signs I'm seeing. JP Morgan, this was the diamond bottom. Rallied, basically gave most of it back, now rallied up. If you lose these lows, this pullback or this higher low, 54.33, not going to be good. It really would have been better if Jamie would have waited and got the primary trend and the 50. But this is now just a consolidation pattern, and I think you really have to wait to see which way we break out from. If it's above 59.65, we'll go higher, although look where that is, a 50-day moving average. So if you're playing long, I think that's a good sell point. And if we break this area, particularly this pullback low here, this 54.33, yeah, not going to be pretty. Goldman Sachs, more like golden parachutes these days, considering how much it's been down. All right, so let's not BS each other here. We basically have a double top, and we didn't quite get there. We have a head and shoulders, a breakdown, getting close to primary trend. So I'm kind of warming up to this short term for a throwback. But bigger picture, if we got back up to like the 172s and it was, maybe we'll get there with earnings and the downtrend, it's probably a right or right out short, because often you'll have the head and shoulders, the breakdown, the check back, and then the real move lower, which could be quite dramatic. So think IBB when we talk about this. So that is kind of what I'm thinking. I'm thinking there could be a little bit more short-term weakness, but I do think intermediate, we are due for a little bit of rally, and then I want to try right or right out short. So on that note, I want to go watch the Oscars. I'm sure a lot of you either are or want to as well. Let's leave it at that. Let's have a great week. If you're not following me on Twitter, my handle is @JustinPulitzer. If you like this video, hit the subscribe button. I assure you, you won't be sorry. You'll get notifications when I post new weekend review videos, new Periscope rebroadcasts, or special edition videos. Hint, hint, there could be DCF and bond analysis coming in there. And hit the like button. Leave me some comments. It's you guys and gals who help me make these videos better with your feedback. Anyway, let's have a good week, and cheers.